Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free. Now let's look at the call ratio backspread. So what is the call ratio backspread? This is a term used to describe a very bullish investment strategy that combines purchases and sales of options to create a spread with limited loss potential and mixed profit potential. Traders use call backspread strategies when they expect the price of the underlying to rise. Now, gains can be significant in this if the underlying financial instrument ra- rallies, that is, the price will increase. So, as we can see in this small chart given here, so the profit and loss potential here, and this is the price of the underlying stock. So, the option is written when they expect the price of the underlying stock to rise. So let's look at the components of the call ratio backspread. So this requires two components. So first is the selling. You have to sell one or two at the money or out of the money calls. That is call options. And for buying, the buying options, you have to buy two or three call options that are further away from the money than the call that was sold. So let's look at the maximum gain, loss, and the break-even points in this option strategy. So the call backspread profits when the stock price makes a strong move to the upside beyond the upper break-even point. There is no limit to the maximum possible profit. The formula for calculating profit is here. So the profit achieved when the price of the underlying is greater than or equal to 2 multiplied by strike price of the long call and minus the strike price of the short call and plus the net premium paid divided by the received. And one more way to calculate the profit is price of the underlying minus strike price of the long call minus the maximum loss. So let's see how to calculate the maximum loss. So the maximum loss for the callback spread is limited and is taken when the underlying stock price at expiration is at the strike price of the long calls purchased. So this is calculated by strike price of the long call minus the strike price of the short call plus or minus the net premium paid or received plus the commissions paid. So maximum loss occur when the strike price of the long call decreases or when the price of the underlying goes down instead. There are two break-even points for the callback spread position. The break-even points can be calculated using the following formula. So the upper break-even point is calculated by strike price of the long call plus points of maximum loss. The lower break-even point is the strike price of the short call. So what strike price to use in this ratio back spread? The wider the strike price difference between short and long call options, the lesser in the money call options you need to sell in order to cover the price of the long call options. The bigger the profit if the stock goes down, but the further the lower break-even point becomes. The narrower the strike price difference between the short and the long call options, the higher the profit potential and the nearer the lower break-even point. But the lower the profit would be if the stock goes down instead. So here are some of the pros and cons of this strategy. The pros is that the credit spread and there is no upfront payment needed. There's unlimited profit potential to the upside and limited profit potential to the downside. And the cons is the broker needs to allow the trading of the credit spreads. You will make less profit than a long call option strategy on the same rise in the underlying stock. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free.